welcome to our latest virtual roundtable brought to you by Bridging and Commercial and kindly sponsored by Medianett Property Finance. Thank you very much for joining us this morning. My name is Beth Fisher. I am the Publishing Director at Medianett Publishing. We are the makers of online titles Bridging and Commercial, Development Finance Today, and the bi-monthly print Bridging and Commercial magazine. Today, we will be discussing what the specialist finance industry needs in 2023 and beyond. Over the past few years, we have seen significant shifts in the UK bridging market. According to the latest annual EY UK Bridging Market Survey, 72% of the sector agreed that competition increased and 85% expect this to continue to get heated. I'm interested to hear whether the panel agrees and if we can expect to see even more bridging lenders enter the market, despite the hurdles that are predicted on the horizon. This includes, but isn't limited to, inflationary pressure, changes in regulatory and tax rules, higher interest rates, the increase in defaults, a drop in property values, the wider impact of the war in Ukraine, the plummeting value of the pound, as we all saw yesterday, the cost of living crisis, and macroeconomic uncertainty. Quite a selection there. I'm sure this audience will have many questions on this, so feel free to ask them all your burning questions over the next hour. The EY report also found that 60% of the industry expects institutional funding to continue to grow, and more than half are looking to diversify their product offering, while 43% are considering regional expansion. Electronic signatures for legal documents and AVMs have also become quite popular over the last 12 months. I'm keen to see if the panel believes these trends will continue and how this could influence how lenders, brokers and lawyers in our market do business across the UK. Later, we will also debate whether there will be a change in distribution channels over the next 5 years. Almost half of the EY survey respondents think that the origination costs will increase, with interest rates now at 2.25%, the 7th consecutive increase since the bank cut the rate to 0.1% 2 years ago as a result of the pandemic. Will we start to see brokers passing on a portion of their fees to their clients as bridging rates become more expensive? Alternatively, are lenders looking at working with their distribution channels in a different way? Over the next hour, we will look at key societal trends that are likely to infiltrate over the next 5 years and how bridging businesses will need to adapt and restructure in order for the market to continue to grow. Joining me today to discuss their own experiences and thoughts on this are a fantastic group of specialist finance experts who I will now hand the session over to introduce themselves. So if you can all spend a couple of minutes just introducing yourself and explaining what you do, I would love to start with Adam, please.
Hi, so I'm Adam Robson. I am the team manager for the bridging team at Medianett Property Finance. Started at Mint about 6 years ago, so obviously in that time, been quite a few changes. So before that, I was working for a high street bank. So yeah, my sort of role is to manage the bridging team. I do have my own underwriting cases that I will underwrite through to completion, and also a bit of sort of broker relationship, dealing with introducers and structuring deals for best for everyone.
Thanks for that, Adam. And Sam?
Hi, I'm Sam. Very similar role to Adam. I'm a team leader, but for the development side. So I deal with all the development loans. Been with Mint for about 5.5 years. Started my career in property in estate agents, moved over to be a mortgage advisor, and then to bridging and development.
Great, thanks for that, Sam. And Richard?
Good morning, Richard Stock from Sirius Property Finance, whole of market mortgage broker, and indeed pretty much any type of finance on any type of property. So clearly we're talking bridging here, but yeah, the high street, if they're lending, high street resi lending all the way through to bridging, a little bit of commercial development and heavily on buy-to-let as well. It's the only job I've done since I graduated 22 years ago. It might look a little bit longer than that, Adam, but it is only 22 years ago, and that's me.
Great, thanks for that, Richard. Michael?
Morning. So it's Michael Cartwright. I work for Buildloan, also part of the Build Store group. I started my career, or before I started my career, I obtained a degree in building surveying. So I've always had an interest in property and building. And for the last 16 years, I've been heavily involved with packager and broker for clients looking for any form of short-term finance. So everything from your vanilla bridging cases right the way through to multi-unit development projects.
Fantastic. And last but definitely not least, Sara.
Hi, I'm Sara Griffiths. I'm a partner of Ratio Law Solicitors. We're a small law firm with big law firm expertise. We specialise in property finance, commercial property and real estate. It's my goal to work with all types of businesses and individuals across the industry in order to be successful and to be able to offer a community of experts in each area. With this in mind, we are constantly assessing the current market, predicting the future market and looking at new and innovative ways to improve our clients' experience.
Okay, fantastic. So that's everyone today. Thank you guys for your introductions. I have sent a message to the audience. So just a reminder, you are free to submit your questions throughout this hour of panel discussion. You can do so by using the chat box on the right-hand side of your screen. We will aim to answer those in the last 10 minutes of the session. So please do ask as many questions as you want. We'll try to get through them all. But otherwise, let's kick off with our first question, which is all about how the panel thinks that the bridging industry will change over the next year, well, 1 to 5 years. So Adam, do you want to kick us off with this one?
Yeah, so I think you know, I'm talking about next year, but the industry is changing daily. Obviously, we woke up today with the news about the Bank of England base rate. We woke up with, you know, lenders pulling products, the Halifax, Virgin. So I think it's down to the lenders now to adapt to all these changes. Obviously, this isn't something new that we've had to do. Obviously, during the pandemic, lenders had to adapt their ways of lending, how they communicate with each other. With regards to, you know, the sort of industry we're going, it's looking like potentially another recession. Is something the industry has, you know, been through and survived. So I think that's going to be the aim of all lenders. I think it's going to be time for sort of more robust lenders like ourselves now to come to the fore, shall we say, and prove the worth to, you know, borrowers, to brokers, just to confirm that, you know, we're here to stay. We carried on lending through COVID. And I think it's looking at results like that for lenders. Is it going to have an impact on sort of smaller lenders or newer lenders coming into the market? Possibly. And I think that's where, you know, people might need to look for homes, you know, for loans for companies who have proven, you know, that they're worth really.
Richard, would you agree with that in terms of smaller and newer lenders? And what kind of other big changes do you expect to see over the next few years?
I think probably the most succinct answer is to give you the 80-20 rule. And I think that when times become a little bit tougher, becomes more pertinent, and we will, as will lenders, get 80% of their business, even more so from 20%, if not a smaller amount of brokers that they work with. And the need for specialist advice is going to be more apparent as well. In terms of new lenders, there are always opportunities in difficult markets, if we can call it that. There are always opportunities, unfortunately, in some instances, but there are opportunities. So yes, there normally is a birth of new bridging lenders during a downturn in normal lending. So I would envisage a couple of new lenders, yeah, perhaps not backed by American hedge funds as we have seen recently, but I think there could be an upturn a little bit, but it's really got to be trusted partners.
Michael, would you agree with that as well? And what other sorts of changes do you expect to see over the next few years?
Yeah, I think what Richard's saying, there's going to be a real need for expertise advice. Obviously, the market's been fairly stable in recent years when it comes to offerings, loan to values, interest rates. I think we're going to see a weekly stroke daily change in what people are offering and the products that are there. I think that guidance is going to be imperative, particularly to the sort of large brokerages out there who don't delve into this world at all, maybe once or twice a year. I think that's going to be an imperative thing. I think with the changing market, obviously lenders are going to have to adapt, but I think innovation and product is going to be something that's very important. One thing that we've seen over recent years is bridge to let products, for example, but they've not been the best. They've kind of gave part of the solution. I think sort of true products where you can have one thing in place for your client where they can buy the property, renovate it, and rent it out. And obviously there's new lenders that are trying to support that, but I think a lot of lenders are going to have to adapt to things like those solutions, because the cost of the finance is going to be ever more important as residuals fall. The end value of the projects are going to go. So to make those projects viable, I think innovation from lenders is going to be really important.
I guess it's difficult as well for lenders to innovate when there are so many changes to do with interest rates and everything else. And I know, especially on the buy-to-let side, I've heard that it's been difficult for lenders to innovate. So it'll be interesting to see if that does come to fruition and lenders are able to continue developing their product ranges. Sam, in your opinion, what do you think are the biggest threats to the bridging industry right now?
I think what obviously people have already touched on so far this morning, on a daily basis the products are changing. So you may well have had a bridging loan, you've got an exit, that exit may not be secure anymore, and obviously cost of funds, lenders are changing the rate, so you might have an offer, you might be ready to complete, and I think criteria and rates are going to be changing. I think that's a threat to the borrowers who have deals that they need to complete and funds that they need to get out. So I think the ever-changing on a daily basis product and criteria is a big threat to us at the moment.
Sara, from a legal perspective, what would you say are the biggest kind of challenges for the market?
At the moment, I think it's the market's being slowed down by various factors in relation to the legal side, and I think in general, just having the uncertainty in relation to the end kind of client not being able to sell as quickly as they would have hoped. Like you say, it then threatens the exit strategy, whether they're then able to remortgage with the lenders they were planning on doing so, because of interest rates are changing and kind of the market then closing itself down slightly to be able to protect what it can. And I think obviously then from the legal point of view, you're then getting a market where you're getting stuck in chains with conveyancing, people who are in the industry who aren't necessarily skilled or have the legal expertise to deal with this more specialist financial property side of it in relation to dealing with bridging and the requirements that are needed from a legal side. I think that's kind of the biggest threat at the moment in relation to tying that in with most people haven't been able to have an exit strategy. And just in general, when people are looking to bridge from a first point of view, or obviously look at buy-to-let option, they're just being slowed down in general and not able to purchase a property as quickly as they thought they would do, which is then putting everything else on hold for their business as a whole, and then for them to be able to build their business within the time frames that they kind of plan to be able to do that in and be able to put properties out and look at things from that side. So I think it's being able to kind of look at the market as a whole, setting expectations from each aspect.
Thanks for that, Sara. Does the panel think that any of the tools and systems that we have in the industry and we currently embrace, do you think that they'll become even more critical next year, and how can they further evolve?
think from
Sam, do you want to start us off on that one?
Yeah, of course. I think, you know, local knowledge is going to be key to each project. So we've got tools in place where we can look at previous loans we've done in certain locations, how well they performed, or, you know, underperformed as such. I think that that's going to be key, because we won't just be able to rely on, say, you know, a person telling us it's worth X amount. I think, unfortunately, there will be projects that get delayed over the next 12-18 months from a development point of view, and having that local knowledge and knowing about projects, why it was delayed, it might not necessarily be a borrower's fault as such. You know, I think that's really going to be key moving forward into an ever-changing market.
Yeah, I think we can definitely look at tools from our side of things to be able to streamline the process, to make things quicker for borrowers and lender clients alike. I think there are things on the market that people aren't utilising as much as they could be doing. So there are things like conveyance certified electronic signatures, which seems quite a scary aspect to some, but it's kind of looking at how we can use them into the market. Can we offer them to borrowers? Can we help speed up the process, and still obviously meet our own obligations in relation to AML, and making sure we are dealing with who we need to deal with throughout that process. So I think from our side, especially from a legal point of view, we can look at our processes in a bit more detail to be able to offer quicker packages for people on both sides. So it's being able to kind of, I think there's a lot on the market that is already kind of there that we can start looking at using to be able to put together and work with clients across the board to just make that a lot quicker and a bit more streamlined for them.
Why do you think that there is so much hesitancy from you know, other solicitors and lenders when it comes to wet ink signatures and electronic signatures? Because I was quite surprised by the figures from that EY report and how many weren't using it.
Personally, I've used them for quite some time in different aspects of what my job role may be. I think the scary thing for a lot of people is being able to give a conveyancer certificate, but I think if you look into the steps that need to be taken for things to be land registry compliant, and you are risk assessing each step and you're doing the job properly, I think that there isn't anything to be scared of. I just think it's moving away from something that's been used for hundreds and hundreds of years. Is obviously making that such a big change for a lot of people is a scary thing. But if you look into how it works and how secure it is to be able to use that, and for the, you know, if the land register can come on board with it, I think a lot more people need to be able to come on board with it as well.
From a broker perspective, so this one's probably more for Michael and Richard, what tools and systems are you using, or do you think's missing in the market, or do you think continue to evolve over the next year?
I think for me, it's the process that we have with many lenders is very labour intensive, you know, because to find out what's happening with a case or progress on a case, it can involve having to chat to numerous channels. It can start with the lender, it can start with Mint, and often ends up with the lawyers. I think in our industry and with a lot of lenders, the online portals and systems that are used in some instances are non-existent, and even where they have been developed, they're limited at best. So I think transparent systems where, you know, everyone involved can get an update on the case, find out where the next step lies, whether it's with the client, whether it's with the broker, whether it's with the lender, whether it's with the lawyer. I think these things are going to be imperative moving forward next year and beyond.
I'd probably just add to that, whilst I'm sorry, Adam. Was it? Sorry,
no, you go.
I'm not hugely IT literate, but they help our industry hugely. But they can also be problematic as well. And Michael just mentioned that a lot of the processes are labour intensive, and there is a labour shortage within the industry at the moment. There has been a lot of people that have moved on or been released because of the pandemic, and I don't want to talk about that much today because it feels like it was thankfully a long time ago, but a lot of these roles haven't been replaced through no fault of the lenders in a lot of circumstances, but they haven't been replaced. And when you have, I know we're talking about bridging predominantly here, but we're talking about the market and the issues and the threats, if you will, of the market that we're moving into next year. We've got to get appropriately trained staff in place now, because a lot of these lenders, it's no good. It's quite a simple man. If I'm running a construction firm and I've not got enough bricklayers, I can hire a bricklayer and he'll be able to start work tomorrow. Underwriters, that's not the same. If Mint takes somebody on, it's going to take them 3, 4, maybe 5 months to give that person a mandate. And whilst that process is going on, then if it's Adam or Sam that's training that person, it's reducing their output of being able to do the day job as well. So whilst IT, AVMs, I'm a big fan of, it rarely lets me down, so I have to say that, but I'm a big fan of IT. This is still a people business. And when it's a tough market, it becomes more of a people business. The systems have to be in place. But if there's a problem, you want to be able to pick the phone up and have a conversation with a decision maker, which we do have with these two guys that are representing Mint today. We have that ability. But the market as a whole, there is a labour deficiency, in my opinion. I'd love to be proved wrong, but if we look at the service from the lenders at the moment, I've never worked in a worse serviced market. Every lender has a period of time where they get knocked over because they're top of the pops and they're the cheapest rate and they get an influx. And historically you go, okay, we'll leave those guys alone for a few weeks and we'll go next door and it's a couple of basis points more. We don't have that luxury at the moment. Every lender is struggling, and for reasons I completely understand, and this isn't a blame, it's just an acknowledgement of the market. We can talk about price until we're blue in the face. That we have far less control over. What we do have control over is service, and that's an issue for us moving forward. So the more IT, the better, but we've got to recruit within this industry again.
I think we've seen a lot of dilution of expertise, haven't we? You know, with certain lenders growing rapidly and not having the people on the ground to support it. And that's, as Richard said, it's hugely important for us. We need to have trust in the people that we're working with. And sometimes you do get a real feeling of a dilution of expertise because the person you used to deal with is now moved on up the ladder, but that level of expertise has not been replaced. And it's hugely important to go along with better infrastructure and systems.
It's challenging as well, especially if and it leads into my next question about whether or not you expect to see more finance providers in the bridging market over the next year or so. I mean, we as a publisher see new lenders crop up all the time. So how can, with a recruitment pool so small and stretched at the moment, how can these lenders actually serve the market if it continues?
I'll be quite blunt there. I don't think they can. I think if there's somebody looking to invest into the bridging market, they're better off trying to invest with somebody that's established and knows what they're doing and has the resources to do it. Whilst I think, and I said it earlier, so I'm not backtracking from that, I think there are opportunities for new lenders in any, especially a downward turning market, which we expect we're going into if we're not already. There are opportunities for bridging. That's the history of bridging. Yeah, when lending is tough, bridging becomes more popular. It's become more commercially minded recently, we know, but there are still more opportunities. But to set up fresh, recruit, when you've got such established lenders in the resi retail space that are struggling to recruit great underwriters, that's the politically correct word I should use, great, to recruit great underwriters is not going to be easy, and it's going to be expensive because they're in short supply, and supply and demand then dictates price, right? So yeah, it's going to be tricky for any new lender, but there will be opportunity.
Mint, from your so Sam, Adam, from your perspective as a lender, what are you doing to try and obviously attract and retain talented people in this market? Are there any other initiatives that lenders can do to try and get hold of the talent that they so desperately need?
I don't think it's just sort of lenders per se. I think it's companies now. I think, you know, with everything that happened with the pandemic, you know, working from home is very key to a lot of people, and it's benefits like that. You know, we invested heavily sort of in our systems that we could. I mean, before COVID obviously came, we invested heavily in systems so we could, if work needed to be done in evenings or weekends, we always had that facility. And I think it's just things like that. I think it's other benefits, sort of in-house, especially for ourselves. We sort of, as Richard sort of touched on shortly before, we invest in our own sort of talent. So we look to increase their skills and training, etc., throughout, so they can progress their job really within Mint. Myself and Sam, we started as underwriters in Mint, and we progressed to team leaders. And I think it is just about investing in your people, rewarding good performances, and other sort of little benefits that go with that. We celebrate everything internally. Birthdays, we have a WhatsApp group for the whole of the company that everyone gets involved in. I think it's just little things like that that you need to keep to retain your staff, so they're not wanting to go elsewhere. Which we once we have staff here, we have a very small sort of shortfall of people leaving because they want to stay.
I think it comes down, doesn't it, to the culture really. If I appreciate that people like to work from home, you have to have that flexibility, which we get with Mint, but I think full working from home, unfortunately, you don't get the company culture, and then it just comes down to pay, doesn't it? You're going to work for whoever's offering the most, because the logo on your computer screen could be any company. So I think that having that flexibility, you should be in the office and understand the culture, and like Adam touched on, the rewards, obviously with health benefits, things like that, all are taken into account. But I think that flexible working in the office, majority of the time working from home as and when it's needed, really helps keep the staff.
Knowledge is passed down as well, isn't it? Like being around each other, and training people from bottom up is a big thing, especially in house when you're looking to retain staff and people and pass that knowledge on. If you're a more experienced person in that industry, then there's no point you sitting at home keeping that to yourself all week. You need to be able to be in the office and sharing that knowledge, or at some point, or in an environment where you're able to share that knowledge with your staff, so that they are also around it and picking that up, and building their own kind of knowledge on that, to be able to, like you say, when they move on to something else, there's somebody there that can pick up that point for that person as well.
I think something to add to that that's equally important as well, nearly equally important, is what I've always called knowledge fade. That if you're in the office, we all, it's not just about learning new things, it's about making sure you don't forget other things, because the industry is so vast. There are individual tasks are not tricky, but there are so many different solutions to so many different answers that preventing knowledge fade is just as important as increasing the knowledge. And I think doing that with whatever aspect of our market you're working in, that is so important to make sure you do that, and the best way to do that is in the office.
I think it's just little things as well. So for instance, we might be, one of my guys might be underwriting a case and they might need a valuer of a HMO in Carlisle or something. So I think it is just, it's using people's expertise, like you say, and sort of learning from that, but bouncing off each other, I think, is what helps.
Moving the conversation on to distribution channels. So now we're talking about internal, mainly lender staff and teams. But if we look at the distribution channels over the next few years, will we see a change on these and like how they're approached? I know I mentioned a bit earlier about fees and rising rates for customers. So yeah, what do you think about this? Michael, do you want to kick us off on that?
Well, we've touched on expertise being hugely important. I think we'll see a change with some of the larger broker firms becoming aware or more aware and pushing this side of the market. I think particularly if we see a bit of a slowdown in other areas, because as Richard mentioned earlier, it doesn't really matter what happens in the market. The bridging finance is always reactive to the needs of what's going on. So whether it's, to extend time for sale or even just your simple downsizing, I think it was something that a lot will push their brokers into exploring more. While I see that they want to do it themselves, no, I think they will rely on the expertise that they can find within specialist packagers like ourselves. I think that's going to be hugely important to give them that extra level of expertise and market knowledge that they'll never have.
Richard, do you expect to see a change in distribution channels?
I think there'll be a natural migration to expertise and borrowers looking for advice more so, where there's a divergence in options. Would I like to see some specialist distribution? Yes, of course I would. But that's being selfish with my Sirius hat on, which rather than talking about the market. So I'll bring you nicely back to the 80-20 rule that I mentioned earlier. But in terms of price, I think there's been too much selling of specialist finance based purely on price. And I think that the expertise moving forward is going to show the real expertise and how to put a deal together and not just sell on price. If I can be a little bit flippant, it may have been a little bit easy for the last few years to sell on price and fees. Whereas if you've got a development deal and we're arguing over 1%, that development deal probably shouldn't be done if it's made or break by 1%. So yes, I see there being a greater need for expertise. Yes, price is clearly going to become higher, but I think the expertise and actually putting the deal together, especially within the development space with Sam, then yeah, I think we need to be able to advise clients appropriately all the way through the process. So yeah, I think it may narrow. To be succinct, which I'm clearly not very good at, I think it may narrow.
It's an interesting point, and definitely rings true with a comment that actually a broker made on a webinar last week that I was hosting, and they said that previously rate might have been one of the first questions they asked a lender, but now it's probably the third question, and actually the first two are ease of lender and certainty ones. So I can, just from the way that everyone's nodding, I feel like that's true to you guys as well. Adam, from a lender perspective, distribution channels, are we going to see movements from you guys over the next couple of years in terms of how you work with distribution?
I think it's going to, for ourselves, it's probably going to largely remain the same. I'd say the majority, 90% probably of our introducing deals do come from brokers. And the advantage of that is, the guys know exactly what they're doing. It's packaged up. You know that the borrowers had the sort of the correct advice. They know what they're doing, and it's just good that, for instance, I know I work very closely with Richard on quite a lot of his deals, and myself and Richard can have chats about deals on Friday nights, Saturday mornings when he's at the rugby, and I think it's good to have that sort of relationship because you can bounce ideas off each other and you both sort of understand exactly where you're coming from. So no, I think from a lender's point of view, especially ourselves, I think it probably would remain sort of as it is at the moment.
And then moving forward in terms of events, so you've got a bunch of traditional events. You've got your expos, exhibitions, and kind of broker training workshops, that sort of thing, and roadshows. What role will these events play in the future of the industry? Michael, do you want to kick us off on that one?
I think a well-organised event's a fantastic place to be. In a very short period of time, an afternoon, a morning, or even a day, it allows brokers to come in and get a real feel of what's been sold in the marketplace and what's on offer. I think you can't beat face-to-face contact, particularly in starting a relationship with someone. COVID is a prime example of that. If it was the other way around, you know, none of us would be going to the office, none of us would be interacting face to face. So I think these are hugely important. And I think also it gives an opportunity, not just to sell the headlines of a product, but to spend real time with brokers, with clients, to explain to them what's on offer and give them a real feel of how you can support them. So I think it's imperative for a well-organised event.
As brokers, do you feel that there are sometimes too many events in this space? I feel like every week there's something going on. Do you have to pick and choose or cherry pick what you go to, or is there something which you find really helpful as a broker or a lender in this market?
The short answer is yes, you do have to cherry pick, because there is a day job. So they are vitally important, but possibly less important right now because things are changing so quickly. But I think come the new year, and that's not to say that anything that's happening between now and the end of the year isn't going to be good, but I think that the importance of them moving forward will be vital. It's about education, isn't it, for all of us, for lenders, brokers and clients. There's going to be a lot to be learned over the coming 3, 6, 12 months, and possibly thereafter. And we just need to ensure that we've not forgotten the lessons of the credit crunch and the pandemic, and know that we can trade through this. I think what we're looking at in front of us, whilst challenging, whilst difficult, whilst worrying at times, it is a market that appears today. I am very aware that that phrase might make me look stupid in a couple of months, but I am very, very confident that this market, how it's shaping up, can be traded through, and there will be opportunities for everybody within the market.
Yeah, and I think with the market being unstable as it might be at the moment, I think it gives people an overview as to what is going on. If they are feeling slightly confused as to where things are heading or might be heading, kind of these events are a good place to be able to go to and look what is available at the moment and what kind of aspects and who's doing what and where the expertise is, and who's getting involved with who, and being able to build on them relationships and then meeting people face to face and talking through how things are going at the moment. What are you doing? What are we doing? And being able to build on that rather than just carrying on what you're doing and not going to any events. And then actually you end up being left behind because you're not up to date with what's going on in the industry.
Do you, as a panel, expect the structure of teams within businesses in the bridging market to change over the next few years in order to continue to thrive? And like Richard said, you know, he's confident that things will be fine, but you know, it is a shaky market, and it could be, you know, it could get more challenging over the next couple of years. So what are you doing as businesses to think ahead in terms of the structure of your teams?
I think especially with ourselves, you know, technology is coming in, so that is going to take over some people's roles. For example, we're going to be, you know, rolling out shortly sort of an automatic ID system. So, you know, that system will complete, you know, AML checks, fraud checks, things like that, which usually would be done manually. However, I think it's important to sort of touch on what Richard said, in that we will always still have, you know, you always need to remain to have that human touch. So we'll always have, you know, that them people doing other jobs. You know, we have various people in Mint. We have, you know, all the way from sales. We also have a portfolio management team who manage all of our loans after completion to make sure they work with the borrower to make sure the loan redeems. If there's any issues, they can be picked up early, so that, you know, penalties and stuff, you know, doesn't happen. So we'll always make sure that we have the people, the bodies on the seats really, to pick up the phone. I think that's very important. We're sort of quite a manual lender in that we underwrite each case individually, and we'll always pick up the phone, and, you know, if we've got an issue, speak to Richard, speak to Michael, and work through them together. You know, we're definitely not a computer says yes or computer says no type firm. So I think, as I said, I think in sort of technology coming in, there will be some changes. It will be for the better, we believe. especially for the borrower. You know, they're not going to want to send IDs, bank statements, anything like that in when it can all be, you know, automated now. But no, I think, as I said, the people who would do the most would then be trained up elsewhere within the company to benefit the borrowers and the brokers, really.
Sarah, from a legal perspective, how will your business be changing the structure of its teams or how you guys work?
I think it's quite similar in that we still want to have that legal, that personal touch with our clients, whilst we're going to look into a more technology based to take control of a lot more admin jobs, which we've always done ourselves. We're very much hands-on from a start of a matter to the end of a matter, and there are a lot of aspects of that we don't need to be, and we need to be able to look at the processes and what we can take away from that, so that we can sit and deal with the legal side and put our legal hat on. But also, because the computer can't have, you know, a legal hat and a commercial hat and make decisions from a commercial point of view as well. So you do need that person who's got them expertise to be able to pick up the phone, like Adam has said, and vice versa. We will pick the phone up and say, right, what can we do to resolve this issue? Can we look at other options? Can we structure the deal slightly different? And we want to be able to work closely with everybody in the industry to be able to discuss that. And so whilst we are giving the legal point of view, we also want to be able to give a commercial point of view within that legal aspect, to be able to discuss options with people in the business, so that we're working together with them to get a solution, and we're not just saying this is the position and for them to make a decision on it, and that we are working with everybody in the industry to be able to look at how we then, you know, what our goal is the same, to get to completion, to be able to build a deal that is kind of has a good exit strategy for the borrower and the lender, and that it's legally sound from our point of view, and that we still are meeting our obligations at the same. So we are looking at bringing on technology to help with that. And experts in recruitment is, again, for us, it's really difficult at the moment to recruit people with the legal knowledge that we need for a lot of the more complex side of things. But that is something we're very kind of not picky about, but like you say, we are looking to do, but it's difficult at the moment in the industry.
I think what Sarah touched on then, one thing we do at Mint, especially when a case goes into legals, we do what we call an all-party call. So that's a service that we can, you know, so for instance, Sarah would act on some of my cases. So Sarah will be on the call with the borrower, solicitor, the broker, myself as the underwriter, the borrower, the broker, and we'll literally iron out the transaction when we need to complete, and we can set like a time scale together. So we need X, Y, Z by Friday, for example, to be able to complete on Tuesday, whatever that may be. So yeah, I think that human touch will still remain from that point of view. So I think it is key, especially in today's world. You know, people are busier and busier every day, but I do think it is key that, you know, just pick up the phone, and that's what, you know, I don't think we'll ever lose that.
Yeah, I think it's just being realistic as well and setting them expectations. So like a similar case where someone might think, oh, this is going to go in 2 weeks. I'd put an email out, but the solicitors phone me straight away to say this, this and this. So we've set our realistic expectations, and I feed that back to my client and vice versa, and everybody's on the same page. And then obviously I think it's, like you say, them kind of old-fashioned ways of working need to still be at the forefront of our business, for us to be able to all work together and be on the same page. And we'll look at using technology in other ways to be able to offer speedy transactions with electronic signatures, ID, things down that route, and having kind of systems from our side to do kind of admin work that we don't necessarily need to be involved in, and we can look at the legal side and kind of working with all the parties to reach the deal completion.
Michael and Richard, are you have you had to kind of rethink the structures of your businesses in terms of the teams? Is there any kind of changes which you expect to implement over the next year or so?
I'll try and be quick on this, Michael. Yes, it's definitely more admin heavy. So there's more staffing now. Recently, I think there's been another three maybe 4 that have come in to help, because it has become more labour intensive. Have we said that if our lending partners are under-resourced from a labour point of view, which we know they are, that's not talking out of turn, it's a fact, right? After the pandemic, these staff numbers have not been replaced, and that's across every lending in property, not just here, every type of lending. It puts more onus on us as brokers with the admin that we have to provide, but I would probably, the all parties call is now a necessity. I remember, and it wasn't that long ago, that my job was 95, if not 99% done once the offer was out, whatever type of offer. Right now, it's probably only 50% of the way. There seems to be so much more in the marketplace post-offer than there was 5 or 6 years ago, again, laden us with admin. So, yeah, in terms of team structure, I think we'll be more heavy on admin.
Yeah, just to add on to that, definitely staffing is a big part of moving forward, and obviously we've already discussed the challenges of hiring the right people, finding the right people. Back to what I mentioned earlier as well, though, improvement in systems, giving people more access to information, something that we've implemented in our self-build sector. And that's paid real dividends and had very positive feedback, and that's something that we'll be implementing in the coming months in our bridging and development finance sector as well.
Great stuff. We have some audience questions. If anyone has any burning questions, do add them in now to the chat box, because I will be going through them over the next 5 to 10 minutes. But the first one we have here says, investors are now predicting that interest rates could more than double by next spring to 5.8% from their current 2.25% to curb high inflation. How will this affect rates in the bridging market? Maybe this would be one for Adam and Sam to start off with.
I think it will come down to how each individual lender is funded. Now, we have the sort of the added benefit that whilst we've just announced recently, we do have an older more bank facility. That is a very new facility. Before that, we were funded internally, so it's all our own money. So we don't have to sort of, rely on, funders elsewhere. They might have cost of funds, certain percentages that they need to pay or get the rates out on, whatever that may be. We don't have that. So we can sort of, whilst we do need to obviously keep a trend on what the market is doing and what other lenders are charging, we kind of, we're not sort of handcuffed in that we need to offer certain rates to get a certain, return for investors, because it's all our own money.
I have another question here. Do you feel that the large number of bridging firms going into development finance a natural extension of skill sets, or a concern around singles? This might be a good one for a broker to answer. Michael, do you want to?
It's a natural want to progress into these markets, but it has to be backed up with the skill sets. I'm sure Sam would agree with that wholeheartedly. The complexity in setting up these deals and doing it quickly, efficiently, properly, and seeing it right the way through from application to completion is not as straightforward as some may think. And my biggest concern would be a new lender going into that market, whether they do indeed have the expertise to see it through. And it's always a big concern for us when choosing a lender to work with. And again, it goes back to what we mentioned earlier about cost and rate. That's not so important. It's really how's the client going to be supported through their project. Traditionally for a lot of brokers, the deal finishes when the client receives their first tranche of funds. But that's not the case for development. We need to be confident that a lender can see it right the way through. So we know the clients had the support they've needed. They've got their project to fruition, and let's face it, they'll work with us again for their next project.
Yeah, I think that's key for us. We would like to do the next project for each customer, So we're it's quite important to us that our back-end team, our portfolio managers who deal with the cases once they go live, speak to the customers on a regular basis, discuss any issues. Developments never go to plan. We all know that. We set it up the best way we possibly can, but especially in this market, materials are delayed. There's more and more companies wanting upfront payments, windows, etc. So we try our best to work with the customers to ensure we all get to practical completion, and we can then move on to the next deal with the broker and with the customer. So I think it is important that the lenders understand the full aspects of the development, not just moving from bridging into development and not setting it up correctly or not dealing with issues as they arise.
I suppose this works with other product sets as well, not just development, but other specialisms too. You've got to make sure that you have the right skill set on board and not just go into it like the member said, just to check yields. I had another question from the audience just following the question, asking brokers and lenders on the panel what their thoughts are on fixed and floating / variable rates in the market. Who would like to go first on one?
That's a very large smirk you've got there, Adam. This is a poison chalice, and I'm probably going to take the fifth. I think right now, to suggest that anybody knows what is going to be the best option categorically right now, today, would be quite foolish. And that's not because I'm passing the buck, it's just because things are too volatile. You don't have lenders pulling out of lending because they're worried about offering a fixed or a floating rate. It's the volatility. So when I first started, the majority of clients were happy with variables because base rate, whilst higher than it is today, ironically, was much more substantial and even kill for a long period of time. And the premium that you paid for your insurance of a fixed rate was too great for many clients. That's obviously changed dramatically for maybe 10 years or so ago. To the present day, where the converse of that has happened, and the premium you're paying for your insurance of knowing what your mortgage is or whatever type of premium mortgage payment you're paying is being so much closer to a variable that the majority have felt it was worthwhile. So even if the variable worked out better, it just wasn't worth the risk, and therefore the insurance of the fixed work. Where swap rates are, where base rate is, where it's predicted to go, it's a tough question. And I would probably have to have a very, very detailed conversation with each and every client rather than giving a generic response on something like this. Apologies if I bottled that, but that's probably the best answer I can give you today.
No, that's completely fair enough. Sam, do you have anything to add to that?
I think, it is a very volatile market. We don't know on a daily basis what news we're waking up to. Obviously, it comes down to clients' risk as well, doesn't it? What's their risk appetite? So I don't think we can really, know moving forward whether fixed or variable is the best option at the moment.
I have another question here. What can brokers do to limit some of the threats bridging borrowers are facing regarding the cost of living crisis and supply chain issues when it comes to refurb? So I guess this is, on the packaging side. Michael, do you have anything that any advice to other introducers?
I'm really sorry, I kind of garbled at the start of that question. Could you repeat the question?
Yeah, of course. What can brokers do to help limit some of the threats that bridging borrowers are facing regarding the cost of living crisis and supply chain issues when it comes to refurb on a bridging loan?
I think the supply chain issues is more down to cost at the moment. They're at an all-time high. I've not particularly seen them getting any higher. I think what clients need to be, we've had a market where everything's been on the up, apart from rates. So rates and costs are on down, profit levels, house prices are on the up, and that level of optimism can be a bit foolhardy, even in the previous markets that we've enjoyed. So I think building in relevant, realistic contingencies, whether it's time or cost, is the only way that you can really sort of mitigate that issue. And that's our job as well. That's our job when we're speaking to clients and they come in and with unrealistic expectations on time and cost of work, that we highlight that to them. Potentially means that the project they're looking at isn't viable, or just means they need to adjust their thinking and make sure they're still comfortable with the profit levels that they're going to make.
Okay. And then finally, this one was about a prediction on foreclosing on properties to surge. Do you agree that that the market's going to see more properties foreclosing, and how will this impact the wider bridging market and its reputation? Don't know if this is one for you, Adam, Sam, or Sarah.
I think it's very much going to come down to a lender's book. You know, if they've taken risks and they've got, you know, a difficult loan book, then yes, those lenders may, you know, increase on the foreclosures. However, I think it's, you know, something for us is, because we're constantly working with the borrower, we would hope we could identify a problem, whether that be time or cost, early on, and we can look at ways of not necessarily restructuring it, but alternative ways to exit, you know, at an early stage. It's so important, as we've already discussed, the human touch, picking up the phone. It's the same for the borrowers when the deals go live. It's about picking up the phone to the portfolio managers, you know, and raising an issue as such, and hopefully then we won't see a surge in it. We can find other ways to get borrowers off the loans and exit.
I think it's going to be sort of key as well with, you know, I think I'm sort of seeing time and time again when brokers will send me a deal, you know, would you do this deal? I've got terms from X lender. You know, the deals are, you know, I don't know if it's to do with people needing to get funds out or something, but the deals, just to me, looking at them, they're very, very risky. And I think sort of in 12 to 18 months, I think you're going to have lenders looking at the loan book and thinking, you know, we're very high leveraged on this one. There's a risk. You know, we sort of do a loan book review at least once a month with our underwriters, with our portfolio managers, and we can sort of look at the risk in each, you know, in each loan. Each risk would have been mitigated, you know, with this credit reports from all the underwriters, and I think it's just knowing your loan book, lenders knowing the loan book, and you know, thankfully we know each loan, where each one's up to, and then, as Sam just said, we can work with that borrower if, you know, we are starting to see that it might be going astray or it might not be deemed on time. There are certain things we can do to make sure that we can help anyone we can.
Thanks for that, Adam. We are now nearing 12 o'clock, so I will need to kindly bring today's event to a close. I just want to thank Mint Property Finance for partnering with us on today's virtual roundtable, and thank you to our fantastic expert panel for taking time out of your busy schedules to be here. And I also want to thank you, our audience, for joining us this morning. We will be publishing this roundtable in full on B&C next week, for those that weren't able to make today's live events, or for any of you who kind of were tuning in and out and wanted to rewatch some of the highlights. We will also be including a write-up in the B&C magazine, which is coming out mid-October. It will be in a supplement, so do check that out and subscribe. I have put a link in the chat box for you all. If you enjoyed this one, please do check out our virtual roundtable calendar for the rest of the year on B&C and DFT on our websites. But otherwise, I hope you all have a fantastic afternoon, and we hope to see more of you in person soon. Thank you so much.